the bigger picture. If you're an investor, Prashant Khemka, founder of White Oak Capital, joins in. Mr. Khemka, thank you very much for joining in this morning. This is a tough market to comprehend, to understand, and I guess even more so because the exit polls painted a very different picture to what's turning out to be reality, at least so far. How does one prepare for this? And what I also want to understand from you is, of course, if you're a tactical trader, the situation is very different. But as an investor and on your fund, was White Oak sitting on a cash position before this big event?
No, so Samina, to your question of how does one prepare, cash, anyone sitting on cash today would look smart, but would have looked very dumb yesterday. And the only way to prepare for this kind of roller coasters, which can happen anytime, when it was 4 years ago, COVID, sharp fall off, and then a equally or even sharper rise. The best way to prepare for all these is to have a very balanced portfolio at all times. So what we do, as I've often said, we don't lean on any particular theme or any particular set of sectors. Yeah, we have opportunity. You can find opportunities to make money over time in every sector, every industry, every market cap segment. It's best to be broad-based and explore for opportunity across these market cap segments and not across the market segments and the sectors, and not be too focused in a very narrow area. What happens oftentimes with retail investors or retail traders or otherwise also is that they start, following the theme of the day, the flavor of the day, and become very narrowly focused in a small set of sectors, at least disproportionate amount of their portfolio. They might have a large number of different names, and they don't necessarily do all the analytics as much, but most of the portfolio by value gets concentrated into very narrow set of names in very narrow set of industries and sectors, and that then becomes very vulnerable to volatility in the market like we're seeing today. The best way to prepare again would be to have a balanced portfolio across market cap segments and sectors.
You're right, Mr. Khemka, but if there is a fund manager out there who needs to outperform the market, you can't own the market and outperform it, right? You got to take concentrated bets in order to create and generate that alpha to the Nifty, or else one would just buy the index and sit tight.
Certainly. So, Samina, very good question. I would like to clarify, I didn't mean to buy the index. Yeah, that way nobody can generate outperformance. That's like reducing or eliminating risk, but eliminating all the opportunity to make outsized returns as well. I'm saying make investment decision, or bet is the wrong word, but invest based on your individual company analysis. Take big positions or the sizable positions. I don't completely agree that concentrated bets are necessary, Samina, at least in our case, at least over the decades that I have invested, and performance is out there, we do follow a non-concentrated or fairly diversified, or the position size are fairly smaller, but within an industry. So let's say banking is, let's say, 25 to 30% of the benchmark, of the market. You can be 25 to 30% of the portfolio can be banking, and yet you can outperform tremendously by picking the right banks. I'm not saying you be same weights in each bank as the market is or the benchmark is, but you should not. What I'm saying is you can't be zero banking or just 10% in banks when in the market it is 30%, or be 50%. You can be 30% in banks if the market is 30%, and yet can generate very high alpha from superior stock selection or company selection within the sector. And that's what I meant. You can be equal weight in each sector compared to the market, and yet have very outsized outperformance on the basis of superior stock selection.
Right, Mr. Khemka, good afternoon. My question really is to do with the occasion. And of course, at the moment, we do have the outcome of the general election. Keeping that in mind, it does seem like what was expected is unlikely to come through based on the incumbent and the kind of seat share that we're looking at. And of course, there'll be a lot of questions with respect to policy. Policies towards the manufacturing sector, policy towards the services sector. Going in, any risks that you could potentially outlay at the moment should the government, or rather should the incumbent, not have as much of a seat share as was earlier anticipated?
So if we take the current seat combination as a given, obviously this kind of a seat share in 2014 would have been a very welcome outcome. Yeah, today it is taken as a shock by the market if you see just the market number today, because the expectations were built very high yesterday due to the exit poll results. Even on Friday, this outcome would have been a bit of a dampener, but not as much as the market move today is suggesting. I would say give it today, tomorrow, a couple of days, the market would settle down. And from there on, the market would look forward to corporate earnings, which would be a function of economic growth. As long as policy initiatives, policy making does not change dramatically, which this outcome does not suggest, then I don't see any reason to believe that we are we are at the beginning of a downtrend, or that the market returns should be subdued going forward. Yes, what was the excess built in, I think, over yesterday, that's been taken out, and a little bit of disappointment today. But from tomorrow onwards, or day after tomorrow, once the new government is sworn in, it would be more business as usual, assuming the numbers are what we see at this point in time on your screen.
It's going to be a very tough day, Mr. Khemka, but if I'm going to ask you on behalf of retail investors who probably don't have access to fund managers like yourself, if individuals have been sitting on cash because there has been so much of talk about a price or a time correction, we've withered all those storms in the last 6 to 8 months. From where we stand right now, if there is about 20-30% cash that an individual is sitting on, would you recommend upfronting a significant portion of that in the next day or two?
So, Samina, I've never kept cash personally. Over the last whatever years, I've been investing since mid-80s, 85 to be precise, through the bull markets and through the peaks of the bull markets and the troughs of the bear markets. I've always stayed fully invested, because my belief is it is impossible to time the market. It's not difficult or very difficult to time the market, but it is impossible to time the market. And yet the market remains the best place to compound your wealth. You can look at today as a intermittent opportunity to buy. It might turn out that you might have even better opportunity down the line. But for me, the best approach has been, and one that I always advocate, even at the crisis time of global financial crisis or COVID, is to stay fully invested. Yeah, if you have 20-30 in cash, and if you feel very nervous of deploying it all at one time, I would say if I were in that position, and if I were nervous about it, then maybe I won't put it all on one day, but use this opportunity to start deploying and have a certain time frame, or depending on how much insurance or how much nervousness you can tolerate, you can deploy them over the next few days or months. But I am not one in favor of cash at any time.
Mr. Khemka, then in that case, let's pivot a little bit more towards the allocation. At the moment, or at least until yesterday, there was a suggestion that mid-cap and the small cap, stocks were relatively frothier as compared to the large caps. Large caps had a little bit of catching up to do, but today it does seem like we're seeing a sharp correction across. Now, over the next few days, we're also expecting a little bit of more volatility to come through. And still, if you consider the last 12 months in terms of returns, we will still see a significant outperformance from mid-cap and small caps. Going ahead, where do you see incremental allocation towards?
Certainly, see, again, I can't emphasize enough the importance of keeping a balanced portfolio. Yeah, and over the prior time periods that we've spoken, I've said the same thing, that there are certain pockets in small caps and mid caps that have that are possibly run away ahead of themselves. It's not necessarily the entire small cap or mid cap. And same way in large caps, there are certain pockets that have trailed more than the or certain pockets that have run ahead, because even in large caps certain pockets are somewhat at elevated levels, but it's not very broad based. So the important thing is not to get caught up in those narrow pockets, which is where the risk is in most retail portfolios and in some fund management portfolios as well. It is important to not bet on themes. And I repeat, it's not indexing. You can be theme agnostic, you can be market cap agnostic and yet make a lot of money. So it's stock by stock that you must look for opportunities, and yet ensure, in fact, you should ensure that you're present across a wide range of these sectors and themes. And the opportunities are there in banking sector, to your question, Agam. Today, the opportunities are there across almost every sector. Maybe some of the sectors which had, built in a lot of this excess because the extrapolation was made to, perpetuity, as it happens in every bull market. Certain sectors, like in 2007, infrastructure, real estate, and before that, the IT stocks in 2000 bubble. So when certain sectors get extrapolated for decades of a very rosy outlook, then on days like today they get recalibrated. It's important to not find yourself disproportionately exposed to those sectors. Otherwise, there's no particular sector I would advise to be in as of today. I would still say be present across a broad range of sectors.
Any sector you don't like, Mr. Khemka?
Samina, at the risk of repetition, there is no top-down view on sectors. We like
it's
every
a bottom-up
sector,
approach.
Yeah, it's certain sectors that we find less opportunities. So utilities, as an example, we have always tend to find less opportunities. Energy sector, we've always tended to find less opportunities. On the other hand, sectors like banks and consumption and technology and healthcare, and industrials as well, capital goods, industrials, we've always tended to find a lot of bottom-up stock selection opportunity. Now, sometimes these sectors are in favor, other times the sectors are not in favor. And the beauty is we are not excessively exposed to at any one particular sector, because our aim is to identify the best performing banks, identify the best performing industrials. Hypothetically, Samina, if we were good enough to identify the best performing or the better performing or the better half of names, companies in every sector, then we can be mirroring the benchmark and yet do fantastic job in delivering returns. And that's the effort, rather than trying to figure out which sector would do better or worse. But to your point, we are very less exposure to utilities and energy sector.
While you might have had a balanced portfolio, I don't know about your mutual funds, but your PMS has always been a stark outperformer as compared to the index or its peers. But one quick question, of course, this event will be behind us in a few hours from now. FIs that we've talked about so extensively in the last couple of months have pretty much shunned the Indian markets on valuations. And for good enough reasons, some may argue. You've got Hong Kong that trades at 1/3 the valuation that India currently is. What did you make of the earnings season that was behind us? And while India has always been an expensive market, do you feel like the current valuations are justified?
So Samina, thank you. First of all, I wish the performance was as consistent as you suggested, but always that's what we aspire for. On FIIs, obviously, when they see this kind of volatility, that would give them a pause. As of yesterday, obviously, you saw yesterday's figures. FIIs had one of the largest inflow day in a long time, in comparison to any other time, say $800+ million of inflow. And if the outcome today were to be along the lines of exit poll, that is what would have been comfortably expected, that you'll see many such days over the coming few weeks itself. However, with the volatility that we are seeing today, it is possible that the flow pattern in FII remains highly predictable over the next few days. One additional thing, though, I want to point out regarding the last many quarters or years, the outflows that you're seeing from India, or I would say we haven't seen outflows as much as no a common underlying trend in FII flows. Sometimes it's big outflows, sometimes it's big inflows. The reason for that is more because 80% or somewhere 70 to 80% of the money that's invested in India by FIIs is through regional or multi-regional funds like emerging markets and global funds. Now, emerging markets have been in a soup for last decade. Emerging markets have trailed developed markets. And so there have been massive outflows of emerging markets globally. And so if India is 15 to 20% of emerging markets and say $50 billion flows out of emerging markets globally, because it's a multiple $1 trillion asset class, call it $2 trillion. If 50 billion goes out, that's about 2.5% of the asset class. But out of 50 billion, $7 to $10 billion would flow out of India, even if investors, global investors, which we believe is the case, are adding money to India dedicated mandates. So India dedicated money is coming in, but emerging market and global money going out, and that being a large bucket, becomes like what they call, I guess, fait accompli for India to also see those outflows. I hope that explains, Samina, what has been the cause for outflows in the recent past.
It does. Mr. Khemka, one last question to you. All eyes will now shift to the budget. How important is that event going to be, in your opinion? How important should it be, rather?
Absolutely. Just prior to that, I missed the prior very important question, Samina, that India trades at 3 times the multiple of China. But if you look at historically, not just India, but all democratic countries, this is something, a research that White Oak has done a lot of work on, and surprisingly haven't seen many others do as much or anywhere in that direction. Democratic markets globally have traded at huge premiums to authoritarian markets. India being, as you can see today, the best example of a very well-functioning democracy. India being one, India also has always traded at a substantial premium to other authoritarian regimes, not just China. And China, since you made the specific comparison, over the last few years have in a way reversed course from a country that was moving towards democracy gradually, or expected to move towards a democracy gradually. It has reversed course, and hence China has gotten substantially derated. India has not really gotten re-rated upwards over the last few years, but China has got derated. But that aside, yes, there would be even greater emphasis now on the budget that might have been the case. Let's say, then would have been expected to be the case till last week, because now there would be certain pulls and pressures expected on the government from various quarters. So in that situation, investors would be very keenly watching whether the government would be able to maintain its emphasis on the progressive policies and on the pro-growth. Growth meaning greater outlay on capital infrastructure, on ease of doing business, and all those emphasis is what investors would be looking very finely for in the budget to come.
Mr. Khemka, such a pleasure talking to you, and of course, thank you for calming all those stressed nerves at this stage who are all very worried about what their portfolios are looking like. It's a tough day. It's a tough day not just for the politicians, but for investors and traders as well. And hopefully we will see you soon, Mr. Khemka. Thank you.
Thank you, sir.
Well, that's Prashant Khemka of White Oak Capital, breaking it down for us, telling us that you should be having a balanced portfolio. There are themes and cycles, but a bottom-up approach is what an investor should be having.